Welcome back. Shareholders everywhere like to see their share prices go up, and they like dividends. But is that in their best interest in the long term? Can short-term share gains lead to fatigue or even pressure to window dress the books? Douglas George takes a look at whether Hong Kong companies deliver shareholder value.
Silicon Valley in California witnessed the amazing boom associated with the technology and internet revolution. For much of the 90s, investors also witnessed as the dot-com bubble on the stock market. It was common to see new stocks that made no profit make triple-digit gains. When internet company Yahoo listed, it marched to a 500% price rise in just a few months.
With the tech companies and with recent decades, last couple of decades, shareholders' value is perceived very differently. Shareholders' value is almost synonymous with stock price appreciation. And shareholders or investors are actually expecting huge jumps in stock prices. When CEOs of these companies come on the press talk to the press, they always talk about shareholders' value, and they tend to look at it almost in terms of share price only.
Hong Kong began its own tech stock jaunt in the latter 90s. The GEM board, the growth enterprise market, was designed to bring small, mostly loss-making companies together with eager investors. And Hong Kong saw its fair share of frenzied buying. Li Ka-shing's internet-cum media vehicle, Tom.com, was the most notable jewel in the GEM stock collection. The Li family cachet helped inflate the stock from its $1.78 IPO price to $14.30. The trend fed Hong Kong investors' penchant for a quick, short-term punt, even on pure speculation.
Here in Hong Kong, or the Asian investors, they are more short-term oriented in terms of their investment. So in that case, they will rely much of their profit or returns or wealth creation in the share price appreciation. So in that case, the companies are under much more pressure in jetting up the price.
Wealth created by companies for their shareholders, or shareholder value, can be had in many ways. Good management with a sound business plan or a basic. Also a generous dividend policy to spread the wealth to shareholders. Ultimately, a balanced view of shareholder value is hinged on good earnings.
Making profit for any company is very important that they make profit. And this profit has to be stable and sustainable. That's the most important thing. And these are basically what the managers are looking at. And so if they can sustain these profits, essentially that should be reflected in their share prices.
Shareholders are rational. They either go for more dividend. If they buy a company, they expect this company to pay regular dividends in a handsome way. That's great. But if the company is not distributing dividend, they will extract value from those companies through the stock price.
But in a fallout from the old dot-com days, company managers have tended to focus on share price growth alone. Short of manipulating the books, managers take great pains to communicate with investors in support of the share price.
Companies, CFOs or CEOs would have press conferences, conference calls with financial analysts on a monthly or even weekly, bi-weekly basis. So basically, these CEOs and CFOs, these companies are releasing so much information to the market to manage, partly to manage the expectations of the investors.
They try to deliver a good share price performance by maneuvering the earnings expectations or certain numbers here and there to meet the short-term stock price performances. And in addition to that, it's actually very dangerous for the companies because when they decide a strategy based on fairly short-term view, in the end, these companies would hurt over the long run because the strategy is not to deliver value over the long run.
In one famous example, Bill Gates' company, Microsoft, relied solely on price growth to deliver shareholder value and never bothered to pay a dividend to shareholders. That is, until last year. Luckily for shareholders, Microsoft has made millionaires of many of its investors.
And press the start button.
The expectation that share price growth alone is the be-all and end-all of shareholder value is also pervasive in the fund management industry. Many fund managers do not want to see a company's funds spent in places that do not contribute to future growth. For many, dividend is a dirty word.
For most industries, industrial, manufacturing, certainly the technology sector, fund managers do not generally prefer dividend to be paid because when there's less money staying in the company is not able to buy other companies, engage in mergers and acquisitions.
But this fund manager disagrees and says many more fund managers now are supporting dividends than perhaps 5 years ago.
Especially nowadays, for the past 2-3 years, the interest rate has been so low. So a lot of investors, they do not mind the companies pay out good dividends because they treat it as a better alternative than putting the money into the banks. To rank, for us, a buyback share is good. Payout dividends is actually even better because it's real return that we get from the investing into the company. And then in case the company, of course, the first priority should be to put the cash, excess cash into other investment which they find attractive. But in case they can't do so, we would rather they don't pressure themselves.
Despite the balanced view of shareholder value by fund managers such as Hung Kong U's Chris Chan believes most companies still feel a lot of pressure to manage investor expectations and meet key numbers as the sole method of delivering what they see as shareholder value.
They feel, you can never please everyone at any time. You're pressured by the fund managers, financial analysts, or the investors to achieve these earnings targets and get these financial 1 or 2 numbers. It's always this hurdle to jump over every whatever periods.
I think it's natural that managers should feel pressure from the market because that's what they're paid to do, is to run the business and generate performance, and if they don't, they're not doing their job properly.
Investor David Webb believes the market itself will regulate companies obsessed with share price growth alone. Companies interested in jacking up expectations and not in sound business plans will eventually be spotted by the market and their shares sold. He adds shareholder value suffers in Hong Kong mainly due to a lack of transparency and majority shareholder abuse.
They often hoard cash rather than running efficient balance sheets and returning surplus capital. They often speculate in non-core activities like property or the stock market. And they often try to extract value in favor of themselves through excessive bonuses and pay as directors or through related party transactions.
He would like to see quarterly reporting adopted to shed even more light and put more pressure on company managers to act in shareholders' interests. Professor Chris Chan disagrees.
That is true only to a certain extent, I would think, because if the information disseminated more frequently is misleading or less reliable, having a greater frequency of disclosure, it doesn't necessarily bring benefits to the market. The quarterly reporting will create additional pressure, certainly at the top tier or second tier companies. Companies that are more popular, they have a lot of attention, not just the retail regular investors, but also institutional investors. There will be additional pressure.
I think that's a red herring. If it was true, then we shouldn't require companies to report twice yearly either. We should let them report every 5 years or so in line with the economic cycle. And we can just speculate in the meantime about how the company is actually performing. Now, clearly that would be an absurdity.
Morningstar's Chang advises investors to choose managers who take the balanced view of shareholder value. Their funds are likely to do better over the long haul. She'd also like Hong Kong to catch up to the West in transparency.
Here in Hong Kong, companies need to report their earnings or information, essential information, every half year. But in the States, it will be quarterly. So in terms of disclosure, the Hong Kong companies might not be so good.
And that is Money Magazine for this week. Thanks for joining us. Good night.